Most retail investors react to outcomes. They buy after narratives are already established. Professionals, of course, don't do that. They monitor the inputs. They watch how demand is changing, how orders are moving, where inventories are tightening or loosening, and which industries are quietly improving beneath the surface. Those changes often show up quarters before they appear in earnings reports, guidance updates, or analyst upgrades. And the important part is, it actually only takes about 20 minutes a month to track these signals, if you know where to look. And so it's important to have your ear to the ground. The opportunities are there, they just don't announce themselves. And this is exactly where the ISM and the PMI surveys come in. The ISM reports are monthly surveys. They are real businesses telling you how things are going right now. And they cover two parts of the US economy: manufacturing PMI, which includes factories, goods, machinery, and hardware, and services PMI, which is retail, healthcare, finance, tech, travel, and software. Services actually make up roughly 80% of the US economy, which is why that report is actually really important today. Each index runs from 0 to 100, but there's one level that really matters, and that's 50. Above 50 means expansion, below 50 means contraction. And this is why the PMI is considered a leading indicator. And that's because companies experience demand changes first and then report earnings later. And interestingly, of course, when you see a sector which is starting to improve in PMI data, you typically see a familiar pattern. New orders rising, backlog stabilizing, inventories tightening, and employment stops deteriorating. That actually often leads to earning beats 1 or 2 quarters later, followed by guidance upgrades and valuation re-rating. And this is how institutional investors operate. They identify improving industries early, they look for companies that haven't been repriced yet. And just to let you know, the PMI doesn't tell you what to buy, it tells you where to look. I think that's a really important distinction here. So I'm going to spend a bit more time on the manufacturing first. Even though the services dominates the economy, manufacturing is actually where the turning points show up earliest. And as we go through this, I want you to focus on one component in particular, which is new orders. It's the most forward part of the survey and often leads the earnings by a quarter or two. Anyway, let's get into it. At the headline level, the manufacturing PMI came in at 48.2, still in contraction. On its own, that tells you manufacturing is weak, but the headline number is not where the insight is. The real value in PMI is understanding where behavior is changing, not just whether the index is above 50. So as we go through this, I'm not just asking, is manufacturing looking good or bad? I'm asking, where is demand stabilizing and where is it still deteriorating? And for that, you need to look at both the sub-industries and the respondent's commentary. New orders came in at 47.4, which is still contracting overall. That immediately tells you one important thing. There is no broad-based manufacturing recovery currently underway. But now let's look at where new orders are improving. The report shows strength in electrical equipment, computer and electronic products, machinery, food and beverage, for example. That's interesting because this tells you demand isn't disappearing, it's becoming selective. These are either AI-adjacent supply chains or defensive categories. And it's also saying traditional cyclicals are weak, targeted demand is holding up, and this is why new orders really matter. Markets don't wait for the full recovery, they react to the change in direction. And here, the direction is improving in a very specific pocket, but not across the board. That already tells you where not to look and where to keep your attention. Production moved back into expansion at 51.4. At first glance, that sounds positive, but context matters. When production rises without a recovery in new orders, it usually means companies are working through existing backlogs, not responding to fresh demand. And that's a classic late cycle behavior, not an early cycle signal. So again, this is not a green light. This is not a collapse, it's stagnation with selective resilience. Let's move into employment, which is weak at 44, firmly in contraction. If this were a genuine recovery, employment would be one of the first things to turn. But only 2 industries are actually adding jobs, which is electronics and machinery, which is important. Companies only hire when demand actually justifies it. So this tells you that only a narrow set of supply chains have enough confidence to expand labor. Once again, the pattern is consistent. Customer inventories are coming in at 44.7, which the ISM is literally categorizing as too low. This doesn't mean demand is strong today. What it means is that reordering becomes inevitable if demand stabilizes. So this is not actionable yet, but it's something to monitor closely. Think of this as a conditional signal. If new orders stop deteriorating, inventory dynamics can flip pretty quickly. Now, onto one of my favorite parts to read. ISM include direct comments from purchasing managers across industries. When you read them together, a very clear story emerges. A respondent in machinery noted that customer requests have increased, but transit times on imports are getting longer. That tells you demand hasn't collapsed, but supply chains are still constrained. That matters for margins, delivery schedules, and pricing. Now compare that with transportation equipment. Here's a respondent saying they're making permanent changes due to tariffs and uncertainty, reducing staff and shifting production offshore. That's not cyclical noise, that's structural adjustment. In chemicals, a respondent says tariffs and economic uncertainty are directly weighing on demand, particularly for construction-related products like adhesive and sealants. That aligns perfectly with what we saw in new orders, weakness in traditional industrial demand. A respondent in fabricated metals talks about unstable pricing and the need to reduce suppliers just to manage risks. That's not demand destruction, that's risk management behavior. And one other most telling comment comes from the electrical equipment and components. The respondent says that trade confusion and supply chain friction makes forecasting demand more difficult than even during the pandemic. And yet, despite all this uncertainty, electrical equipment and electronics continue to show relative strength in new orders, employment, and backlogs. That is an insight. It tells you that demand in these areas is strong enough to survive uncertainty, while other parts of manufacturing are not. So let's be clear about what this actually means. There is not, or it doesn't seem like there's an early cycle manufacturing recovery yet, but it's also not a broad-based collapse. Demand is narrow, selective, concentrated in electronics, electrical components, and machinery. That immediately tells you where not to look and where to keep paying attention. And this is why relying on only the headline PMI is misleading. Now let's contrast that with services, because this is where the picture changes. The services PMI came at 52.6, firmly in expansion. That immediately tells you something important. While manufacturing is contracting and uneven, the majority of the US economy is still growing. Because just like manufacturing, the real signal isn't the headline number, it's how services sector firms are behaving. Business activity registered 54.5 with growth across retail, travel, healthcare, finance, information, and professional services. This isn't narrow. I don't think this is fragile either. It tells you demand is broad-based across consumer and business services. And that matters because broad demand rules out an abrupt demand-driven recession. It also tells you something else. This is stable growth, not acceleration. So this isn't the kind of environment that produces a sudden upside surprise. It's an environment that supports earnings durability. Now, services PMI doesn't feature the same dramatic respondent quotes you see in manufacturing. That absence itself is meaningful. Service sector respondents aren't talking about layoffs, supply chain breakdowns, or permanent restructuring. Instead, their behavior shows something very different. New orders remain above 50, which tells you firms are still receiving fresh demand, not just clearing backlog. At the same time, employment remains slightly below 50. That combination is quite important. It tells you companies are choosing not to hire aggressively, even though demand is there. And they're actually meeting demand through productivity, technology, and pricing. No headcount expansion. And that seems like it's deliberate margin protection stance. Now let's look at prices. The price index remains elevated at 65.4. That tells you service providers still have pricing power, and that pricing power means customers are still absorbing higher prices, demand hasn't broken, and margins are still being defended. So while manufacturing respondents are talking about uncertainty and structural changes, service respondents, through their behavior, are saying demand is steady, we're cautious, but we can still protect our margins. And that's a real signal. So what does this all actually mean? What it means is that the service economy is not accelerating, but it's stable, profitable, and resilient. That rules out a near-term recession, a sharp earnings collapse, and broad-based demand destruction. But it also rules out early cycle upside, explosive growth, and easy multiple expansion. So this is an environment where pricing power matters, balance sheet matter, and discipline matters. And that divergence between the weak manufacturing and the stable services is a big reason the US economy continues to defy recession forecasts. So this is what the PMI actually gives you. It's not a buy signal, but it's context. It tells you where demand is resilient, where it's deteriorating, and where to perhaps focus, or to stop focusing on research. Now, this next part is where most of the work actually is. Turning macro signals into individual stock ideas takes time, and sometimes, even after doing all of the work, you don't find anything worth investing in, which is pretty normal. What I'm about to show you is a very high-level framework for how PMI guides idea generation, not a guarantee you'll always find something to trade. In very simple terms, the process looks like, first, identifying the industries showing improvements in PMI. This month, that's things like AI hardware, electronic components, machinery, retail, healthcare, and finance. Second, screen companies in those areas using basic filters, reasonable valuations, improving revenue, stable guidance, and price action that's holding up. Third, do the real work. Read the management commentary, look at backlogs, capex plans, margins, and where the demand is actually coming from. And then sometimes you'll still pass, but that's fine. I've done a number of deep dive company reviews on this channel already using this process. They're all pretty relevant in my view. That's just my opinion, it's not investment advice. You should always do your own research. Anyway, these ISM and PMI surveys are released at the start of every single month. They take about 20 minutes to read. If this was useful, consider subscribing. Thank you so much for watching, and I'll see you in the next one.